You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funkalicious tune means it's time for the final program of our broadcast, our recording week here on the old network. It's time for TWIFO, This Week in Futures Options, the program where, as the name implies, we break down all of the amazing, the fascinating, the head-scratching, the sometimes downright weird activity that's lighting it up on the other side of the fence. So not just our typical indices and our equity options, but our corns, our wheats, our soybeans, our oils, gold, hogs, who knows? Who knows what's lighting it up this week? That's why you got to tune into TWIFO every week, every Friday, 3 p.m. Central, 4 p.m. Eastern. Of course, if you can, join us live. We'd love to see you there. Mixlr, MIXLR. Same link as always. So if you listen to VolViews or if you listen to Option Block or any of those other programs we do live, Options Bootcamp now, you can use that same link or just follow us in Mixlr, MIXLR, and you'll be notified instantly the second we go live. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned Options Insider Radio Network. In addition to streaming shows live, we love all you on-demand folks. You can get all that goodness, of course, over there at the mothership, theoptionsinsider.com. A great audio adventure awaits you there, or, of course, via the usual suspects, iTunes and Google Play and iHeartRadio and all that other fun stuff. If you want to just grab it on your device of choice, of course, our mobile app, always a good way to go as well. Also available in the aforementioned stores and along with the Amazon Fire app store as well. So if you're rocking a Kindle Fire out there, we got you covered here on TWIFO and indeed on the old network. And however you hit us up, however you stream us and download us, or however you get our content, we'd love to hear from you guys. So hit us up via Twitter or Facebook or email, questions at theoptionsinsider.com. Or, of course, it's all baked into the mobile app, so you guys can hit us up there. And if you're listening live, of course, hit us up live via the Mixlr or via Twitter, and we'll see if we can, if it's a good one, maybe we'll work you into the show. And joining me on the old program today, my cohort, my partner in crime for all things TWIFOing, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use around here called Quick Strike. Mr. Nick, welcome back to the TWIFO program, sir.
Hey, Mark. Good to be back. Hope you're recovered over there from your little criminal of activity in the neighborhood.
Lots of criminal activity going on around here. The streets around the Options Insider Studios, listeners, lockdown, SWAT teams everywhere. But you know what? We don't stop. We don't stop the broadcasting. We keep on going. That's why you just stay in the studio, Nick, and nothing bad can happen, right? Just stay inside all the time, and no bad can happen. But of course, a lot of interesting things did happen this week out there in the futures options land. I guess, Nick, we got to start crude, right? That's kind of where pretty much everyone's attention was on the commodity side of the fence this week. I mean, if you weren't watching crude, then what the heck? What were you doing? What were you watching out there in commodity land? This was the big week. We kind of touched on it a little bit last week, talking about all of the things that were going to come on this week. We had the big OPEC meeting. Would they cut? Would they not? And, of course, leading into that development this week, we saw a nice pop in implied volatility. We saw a nice little love affair going on with the upside calls. We'll get to all that in a minute. Of course, net on the week after the meeting, a lot of that gas has come out of the balloon. I know we saw measures like the OIV and the OVX, which are, of course, the VIXs for WTI and USO, respectively. Both of those have been languishing like the mid-30s. They both popped up into the mid-40s this week, actually. So there was a little bit of life getting out there. Now those are coming back off again as the vol coming off. Net on the week, the vol off, 3 to 4 handles, depending on where you're looking out here across the term structure. So all this juice that got built in as a result of the OPEC meeting kind of coming out now, as would be expected with pretty much any big event risk type thing. Looking at the week that was, of course, it was a very active, very volume-heavy week. Overall, open interest up about 8% this week, which is saying something because WTI is not exactly an inactive contract. So WTI really lightened it up this week. And the contract, in case you were wondering what was number one with a bullet this week out there in WTI, you might be guessing it had something to do with a little bit of upside. You would be correct. It was the NOV 50s, lighting it up to the tune of about 33,000 contracts so far this week. The lion's share of that, not surprisingly, coming on Wednesday, about 12,000 there, and then about 7,000 the next day. So the lion's share coming right around and out the heels of that big OPEC meeting. And then, of course, the rest of the strikes are pretty equidistant across the board. The NOV 45 puts, NOV 48 calls, both doing about 23,000 contracts. 26 for the DEES 40 puts if you're going a little bit longer term out there. But really it was the NOV 50s that really led the charge this week. Kind of interesting too, Nick, I'll let you get more into this in a second, but it's been interesting to watch kind of the evolution of the volatility skew out there in WTI as well. And it's been so interesting. We talked about it even on Volatility Views and other programs, just because it seems like it's been since this sell-off really started that we've kind of been waiting for the catalyst, the moment when the worm turns and the bulls are finally out in force. And we saw that briefly when it first crossed. I believe it was a 60 handle over a year ago, and then those bulls got burned pretty badly. And we haven't really seen it happen since. And a lot of people were thinking maybe this would be the week it might come. And, of course, one of the signs of that catalyst arriving would be some life, some love for these upside calls in WTI and related products like USO and others, because we've been talking, it's been a broken record for the better part of the last year or longer, that the calls out there just have no love. They have no life. You can do bullish risk reversals all day long out there in WTI and other products, sell juicy puts, buy relatively cheap calls, and do it for fairly impressive levels, maybe even some nice credits out there, depending on where you're looking on the strike. So that's kind of been the trade du jour out there. This week, not so much. Those calls, particularly in the near term, getting a lot of life, a lot of love in them. And we saw that, that's happened before where the near-term calls got a little bit of love. But we saw it, Nick, also going out into a few months out, 2, 3, 4, 6 months out. We saw some of those calls starting to get a little bit of life, it's been the first time in some time that we've really seen that development kind of extending, which perhaps, I use the word perhaps because you never know. I wouldn't say this is the exact perhaps moment yet that the worm has turned, but at the very least, in fact, looking at it now, this product looks a little bit different than we looked at it last week from a volatility skew perspective, with a lot more love in these calls than were there last week. Of course, that love has ameliorated somewhat as the week has gone on. The rally out there in crude perhaps not as lofty as some may have hoped for. So some of that luster has come off the calls and not as big as they once were. But still, it's been interesting to watch that perhaps shift of interest, that shift of bias. Because I don't know how long can you talk about people buying puts in WTI for over a year, Nick, before we gotta mix it up a little bit. So I'm curious. You've been looking at the quick skew all week. You've been watching the evolutions in both the call wing and the put wing. Are you feeling it? You thinking this is perhaps the moment where the worm has turned, or are you thinking the fact that the calls gave up some of their juice in the latter portion of the week, maybe this isn't exactly the moment yet?
Well, the numbers that are reflected in the TWIFO report are showing the skew as of the close yesterday. So it'll be interesting to see how much that comes off when we see the final settlements for today. I can take a look over here in a more live version of things to see if I get anything better from a number standpoint of where it's going to end up for the day. But as much as it's come to life a little bit, it's still not much life there. Still pretty negative. I mean, we saw a little bit of a bounce, but I think what you're going to see at the end of the day is, if you taking a look at the report, you've seen that the vol came off significantly. A lot of it, I think you're going to be a little bit. I think you're going to be a little bit disappointed on the upside. There might go back a little bit to where we were at the beginning of the week. But what we're seeing is, vol was up on that move, and then we didn't push through any sort of significant barriers. And I think the initial significant barrier that everybody's looking for is through the 50 strike. We didn't get there, and this week, there's a lot of red in this at the money compared to last week from a volatility standpoint, and most of it, or 50% of it for the most part, come off today. So once there was no continued follow through, again, we did push a little bit on those upside, but then I think it came right back out to almost the levels that we were last week. So a little bit of a bump, but not quite enough. And I think, again, just being a observant casual observer, if that's such a term, it still looks like until we get outside that 45 or 50 range, we're going to be sort of generally indifferent here with the skew. We have to get past that upside in order for people to start coming at it. With that said, like you mentioned, out in the March 2017 contract, we did see some openings in the 57, 60, and 75 calls. So majority of volume that took place in those strikes was opening volume. So there are people making some plays out there, but I think, given no continued rally, we kind of sitting around this 48 and a half range in November and December. So vol's off pretty good. And I think you're going to, if we continue to go sideways here next week, you may see the same. And, and vol, it's low, but it's not quite as low as it's been. So I don't know exactly what's going on here or what people are thinking. It still feels like a short strangle market because we seem to be moving between two strikes and not doing much else. So until there's more news, and there was kind of conflicting stuff with OPEC, and I believe this is the case. They said production limits would be implemented, but then you have Iran contradicting that as well. So you never really know what's going to happen, and you got to get a lot of people to agree in order for that to really come to fruition. So still think they're going to be in a range, and we got to get Shy Girl on here so she could sort of help us out and tell us what she's thinking, because she's watching the market so thoroughly. But still looks like a 45 to 50 range bound, and below that 45 or 40. So a 40 to 50 wide, 45 to 50 range. And until we get past the 50 strike, I don't think we're going to see any big pop on things for the time being. But from a volume standpoint, overall, calls were equaling puts. So again, kind of trading even distribution with that, and still significant call bias on the open interest. So nothing is really jumping out that the worm's turning in that skew, Mark, to be honest with you. And vol's off. We tried and couldn't do it. So we'll have to watch next week and see what happens. Although we are running in, the market should be sort of busy running into the non-farm next weekend or next Friday. So we'll have to take a look and see.
You're playing the role of wet blanket this week, Nick. I was hoping this would be the week that we would finally see it. How long have we been waiting for this moment, this catalyst, this catharsis, call it what you will, in Crude, where it's finally turning, and if anything would do it, we've been waiting for OPEC to finally set this floor and cut production, and they finally seems like they actually went around and ahead and at least tried to do it this week. Of course, as you mentioned, the rubber meets the road with this stuff, and getting member nations that are pumping oil as much as they possibly can to make any money at these low levels, getting them to somehow cut production is always a challenge. So we'll see if all of that comes to fruition. But you're right. It seemed like it was setting up that way. And then as the week went on, the luster kind of came off, the bloom came off the rose a little bit. I am kind of going to probably nominate those. I mean, they're March. They're a little bit out there. And maybe you got something else in your back pocket that is even wilder. But I'm going to nominate those 57s, and I think you said 60s out there in March. The 60s more so as kind of maybe my nominee for Crazy Trade of the Week, just because that's pretty aggressive. That's pretty. They're obviously buying what OPEC is selling here, which is interesting. Apparently, the rest of the market was, and then perhaps not following suit. Certainly, Mr. Nick. He's just not loving it all. Any of you crude bulls out there, send your angry emails to Nick at Quick Strike, not to me. All right, moving on. I don't think the crude bulls are as aggressive as the gold bugs, Nick. So I think you're in luck there. Let's move on. Speaking of gold, let's move on to the shinier of metals, the shinier of products. We were talking, Nick, kind of the story in WTI and those products was a bit of a pop in vol, then kind of coming off the other end. The story on gold is kind of just vol, the other side of the coin. Vol just in the doldrums, in the nadir, hitting 52-week, actually I think multiple year lows, depending on the product you're looking at, the GLDs and the COMEX Gold and others. But yeah, multi-year lows out there from an implied vol perspective. So after gold kind of rocking and rolling a bit this week, at least from a vol perspective, not so much. We did see some underlying movement, obviously, out there, giving up about 20 handles net on the week. You think that might juice some of the vol to life out there, but then again, not so much. Most of the vol across the term structure coming off about a point or so. So still pretty aggressive for vol that seemed like it couldn't get much cheaper. Guess what? It can. And off a drop, no less, which probably would surprise some of our listeners who are used to the investment skew on the big indices and others and expect a downside to equate to an increase in vol. That's nice about futures. They don't always work that way in the futures options, and gold is no different this week. What was lighting it up? Actually, looking at total volume, it was pretty aggressive this week as well, similar to crude in terms of nearly an 8% increase in open interest this week, an increase of about nearly 50,000 contracts. So pretty aggressive volume out there. And in terms of what was really lighting it up this week, if you're kind of wondering, hey, sell-off probably puts leading the charge, you would be correct. A fairly equal smattering of the Nove 1300 puts down throughout the week, pretty much doing about 6,000 contracts total. So they're taking the top spot, obviously a lot less than a product like WTI, but still a fairly heavy volume for good old gold. Coming in at number 2, a little bit farther out, again, reflecting that kind of push-pull we see and have seen for quite some time in that 1,300 to 1,400 range. Nick was talking about the range we're in with crude, with the 40 to 50 and the calls and the puts lighting it up on those and the strangles and the risk reversals. Similar scenario out here in gold where we're seeing 1,300 and 1,400, that push-pull, obviously getting a little bit closer to the 1,300 level now with the futures off about 20 handles this week. But still, the 1,400 calls out in Dees were lighting it up again this week with number 2, about 5,200 contracts or so coming in those calls again, pretty even throughout the week, pretty even trading. So again, Nick, we kind of have this push-pull between this kind of strangle here. In this case, it's the 1,300, 1,400 out here in gold, and we've been talking about that for a while. Where was the bias leaning for a long time? It was to the calls, and the puts came back, and then it's kind of been in the kind of equidistant to slight call bias. Maybe this week's paper will erase some of that, but still, it has been kind of interesting to watch. I mentioned at the money vol coming off across the board this week. Net moves in the skew. Not huge, but then again, we know when we're talking quick skew that it's not the net that really matters. It's kind of what moves in the independent put wings and call wings. And Nick, I know you keep an eye on that throughout the week. So what's been catching your eye in the quick skew of gold, as well as anything else that's catching your eye out there in Goldland this week?
Well, it's interesting when you look at it from a skew standpoint, right? It's still kind of, it's one of those things I don't even really have a good way of explaining it. I mean, we still have a call bias, right? It's positive, but the volatility is so low, even from a rich cheap standpoint, it's basically, they're trading right. The out of the monies are trading right along with the at the money. So, a lot of what I wanted to talk about today was just, the range boundness is really pushing volatility down quite a bit. And like you mentioned, we're not quite as low in vol as we could be, but we're really approaching those lows over a multiple year period. So it's interesting, right? We're seeing firsthand what happens when we're trading in this range. Just like you said, we have this 1300, 1400 push pull from a trade standpoint in the options, but from a futures standpoint, really over the course of, if I go here and look at what we've done over the last, let's look at the 1 month first, right? So we're basically around 1310 to 1350, with the 1350 coming on one day and everything else really trending sideways between 1320 and 1340. So, there's really, we hit our low points back earlier in the year, but we don't have that great of a range in terms of the futures. I mean, dollars wise, 1220 to 1375. I guess that's pretty good. But at the same time, when you look at the last 4 or 5 months, you're in a pretty tight range, which is going to make for not a lot of great volatility trade. But I think some of the things I wanted to point out, generally kind of flat. With a little bit of bias towards the call still. That came off a little bit, meaning it was a little bit less bid in the calls than it was in the puts. Like you said, vol's down pretty much across the board. We still have 25 days left in that front contract, so basically like a 30-day contract. That's getting really cheap. We had a big move in the futures this week, $23.50 for the most part, and we traded up as well earlier in the week. So when we've been talking about this rent versus range, how much volatility costs you to have it versus how much of a range you're getting in the futures, and it certainly is paying for itself. Vol continues to come off, but if you are an active option owner and you're working to manage your deltas that you're getting from the change in the gamma as the futures move, I think you can cover your nut there. So it's something to look at. You get on these lows. I made a couple notes here. The vol pattern looks sort of similar to 2012, 2013, and 2015, where we had a lower trend toward the end of the year, and then we spiked higher after the year. Now, 2014 was a little higher near the end, and then we had a downward trend and then a sideways for the remainder of 6 plus months of the year. So whenever you get to, there's the old adage, vol's low, it could go lower, right? We've all heard that before, but we are pretty low now. So there's a couple things just maybe to think about. You find some low strikes. We're on the bottom part of our range here, so maybe it's time. I say this all the time. This is just coming back from the old days. When vol's low and you're at the bottom of a range, you like to buy puts and hedge them, right? So now you're playing two things. You're playing a low volatility, and you're also playing a movement back into an upper part of the range. So I looked at like the 1280 puts; they're worth 3, and they have a 15 delta. So if you do that trade and hedge them, you have a break even, and you have a break even of 1340. Okay, if you hedge at 1320. So that's not so bad. You're moving within the range that you had. You get your money back after a short period of time. You can start to get out of your deltas. You can let them run if it looks like it's a follow through on the upside. And then you also figure you have a low volatility option. It might keep its price as it moves higher, or if it moves through a level, and you can always get out of those too, and maybe at the same price, a significant amount higher. So that's the type of stuff that I like to start taking a look at when vol gets to this kind of level, because you can be short it, but at the same time, you never know what's going to happen there. As far as some activity in the options, there was a lot of opening upside call buying. And this is at some low volatility levels as well. So the March 2017 had 1,500, 1,650, and 1,675 strikes open. April had 15, 16, and 16 and a quarter. June had 16 and 1700. And the D's had 1500 and 1900 way up there. So there are people out there buying those upside calls. They are cheap. So, I still like, if you think that there's a rally, Mark, if you think there's a rally coming or you think that there's more upside in the futures, I still like buying the cheapo puts and hedging them and letting it run up, because now you got a good margin play, you got a good vol play, and you got a good futures range play. So, volume again dominated by the calls. OI basically dominated by the calls. So it looks like people are still looking for an upside, but volatility is not showing it yet. But I think it's time to start watching it pretty closely now.
Well, you mentioned it before, and it's kind of an interesting concept. And I keep saying we should bring it up more on the show, which is that notion of rent. And you wouldn't think, that gold would be would be lighting it up from a rent perspective right now. But things are cheap. You think the underlying shouldn't be moving, but this week it did move. So you had cheap vol. So if you bought it and you had a big move in the underlying, that could work out in your favor, even though vol came off net on the week. So interesting stuff out there in all things gold. It may be an interesting time maybe to start thinking about some puts for hedging if you are indeed on the long future side. The low vol does make long premium type strategies attractive out there, no matter which side of the fence you're going to, the calls or the puts. This week the puts seem to be loving, but next week could be back in call frenzy. You were saying, Nick, too, maybe really quickly for our crazy trade of the week. I'm looking here. Did I see this correctly? We got decent 1,900 calls trading out here in gold this week.
There was, we had 1,900s, and those were opening. Not a lot, a couple hundred, but that's up there pretty good. There was some trades in the 2,100 and the 2,300, but it looks like those might be box trades because there's no open interest change. So that was, I don't know where that's coming from, but yeah, 1,900, 1,600, 1,700. But I think the 1,900, that's probably the most interesting one out that far. That's what are we talking about? Over a year from that standpoint. So, but there was a fair amount of upside that traded there. Again, it's all relative from the, there's a 6% increase in open interest, which is pretty good here. A million contracts, you go to 1,060,000. So some still good trades, still increased open interest, and some weirdo call buying way out there. They still want to know why they make those decisions for that particular strike, right?
We got another contender here for crazy trade of the week. I was thinking the Crude was pretty aggressive, but 1,900. Given today's movements by the end of the year, that's pretty impressive. All right, and let's go back to a favorite. We like to have our surprise product of the week, a thing that's lighting it up. A few of you have asked for this one again, and I think it makes sense because it still is moving a little bit. It was our surprise product last week. We'll let it surprise us again this week. It's back to the lean hogs, Nick. I know it's your new favorite product, kind of a little bit of a new favorite of mine as well. I have to admit, I don't typically watch the lean hogs on a given day. I don't think I'm alone in that assessment. But these last couple of weeks, it has been interesting to watch. The futures giving up the ghost yet again this week, off 8 to nearly 10%, depending on where you're looking out there on the term structure. So these things really moving off about 5 to 6 handles across the board out there, depending on, again, where you're looking. And obviously, lean hogs is not going to light it up like gold, or certainly not like WTI, but still doing decent numbers comparatively this week, up about 5% in the open interest departments, or nearly 10,000 contracts additional this week, which is fairly substantial out here. If you know the strikes, most of the futures fell off to about the mid to high 40 range, depending on where you're looking out here. So the 50 handles and below were low 50s and below were kind of active. In particular, it was the 52 puts that were lighting it up this week to the tune of 3,600 contracts out here. Mr. Nick followed. That was the good old ACK, followed on, of course, by the Dees with very close on the heels here. The Dees 44 puts with about 3,200 contracts open out there. Really quickly to see how this broke down. And that one was pretty heavily weighted towards today, actually, with about half of that volume on those Dees 44s coming in pretty much today, about 1,500 contracts out of the 3,100 or so. So apparently today was the day for downside puts here, Mr. Nick, in the hogs. And again, looking at the money vol, as you might imagine, all this craziness going on out there. Vol ticking up quite a bit, 5-6 points, depending on where you're looking on the term structure. The skew also looking quite askew, getting a nice little sharp bid up here, up multiple points, again, depending on where you're looking on the term structure. I'm just pulling up the longer term view here, Nick, so I can see for myself how this skew is shaping up across the board. And I think to call it funky, the front month certainly very funky, the kind of your traditional smile. Then once you start getting a little bit longer term, things get a little bit more stable, but still, I think any product like this that is kind of so sparsely liquid, different strikes and things, it's kind of hard to really look at the skew like you do like a WTI or a gold. But still, it has been fascinating to watch. I know, Mr. Nick, you've been keeping an eye on the skew numbers. What's catching your eye out here in the realm of all things lean hogs this week?
Let's see what we got. So this one, a little bit the seat of our pants, like we talked about at the beginning of the show, because we didn't look at it too much until today. But futures off, so that trend has been continuing for the last 3 or 4 weeks. So I think we hit some stops here, which pushed us a lot lower. And from what I saw on Twitter, I was watching some of the feedback out there. People were a little bit surprised that we had pushed so much lower. So you get that push, like we talked about in the crude, until we go through the 40 or 50. It's going to be pretty kind of standard, business as usual type stuff. But we push through some levels here. I think a big part of our downside, if you hover over that negative number in the futures, you'll see how much of the change was today, Mark. So you can see that we were down, over half the change on the downside was today.
That would explain the put love for today, would it not?
Yeah. So last week we saw the front month was actually off while all other months were up in volatility. And this week, we got everything back that we lost in the front month from a volatility standpoint and then some. So we doubled up really that loss. Now keep in mind, we are 7 days short of expiration. We're going to lose some in decay. So volatility is going to make up for some of that time decay. But, these December contracts and outward, those vols are up again this week. So over the last couple of weeks, we're looking at 10 to 12 vol increase. So, the futures are moving. What's interesting about these is it's a little bit different. I think it's a little different from the other products that we've been talking about. Is part of this rent versus range. Range is one thing. A range is I start here and I close here. If it's all in one direction, you're not getting the same benefit as if you start here, you go up here, you start here, you go up, so you're getting some movement. So this is covering it from a movement standpoint, but it's not quite as scalpable as you might want it to be, because you're not getting that same sort of up and down. I think the gold and the WTI have a much better up and down movement, at least of late, capturing your deltas on a position that you might have on the long side. So skew pretty much kind of stayed in line, a little bit more negative, more to the put side this week, as you would expect with this break. But yeah, vol definitely pumped up. So what I would imagine is if we see a retracement over the next week or so, you're going to see the volatility come in quite a bit on these deferred contracts. There's 14 days left in the October, so next week you're going to get under 10 days. So that starts to act more, not so much like a volatility derivative, but more like a future, right? So there's not much there from looking at that you can gather from the vol. But as we look at this December contract and the December and the Fed, since those are the two with the highest open interest, you could see some real deflation in volatility if we sort of steady out or move back up into a price range where we came from next week. But again, I don't know a great deal about that market. I'm looking at the futures contract. I'm not so sure about the fundamentals. So maybe I'll have to go take a peek on Twitter and see what guys are thinking and the gals are thinking, and maybe we have a better idea what's going to happen going forward. But I would imagine, just based on purely what we talk about in general and our overall experience with markets, is if we push back up to levels that we're seeing before, you're going to see some of this vol come out.
Yeah, neither of us are hog heads, but we're starting to get a taste for it, I think, literally and figuratively out here as this thing continues to light it up. That's the whole purpose of this show, is finding interesting hot products and breaking them down here for you on the old program. Speaking of you guys, it's time for your turn. It's time for some futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody. Like the man said, this is the portion of the show where you guys get to take the reins with your questions. So if you got some, hit us up. If you are indeed joining us live, we got a few minutes here for the end of the show. Maybe we can squeeze you in. Meanwhile, we got a bunch of ones people have sent in. Let's start with this. Actually, this last one seems kind of interesting here, Nick. This comes from a listener. It goes by the handle Vegs. He or perhaps she wants to know, he says, he's a futures guy apparently. Futures have a 63% win rate, at least according to our friend Vegs here. He goes on to write, how do options compare? What profit percentage can options traders get? And does he know he wants us to recommend some people who have those good track records? I think we'll stay off the last part of recommending people. The first thing you got to learn, whenever people are out there bandying about their win-loss record, 99% of them, they're shall we say, embellishing, for lack of a better word. Yeah, I wouldn't take any of those at face value that you see. That said, it's kind of a more interesting question, the beginning part here. He's comparing futures to options. This is a difficult thing. You know, futures, a little bit more straightforward from a strategy perspective. You can go long, you can go short. That's kind of the long and short of it, pun intended. Options, obviously you can go long and short, but there's different nuances to how you can do that. You can do it in spreads. You can go naked outright short. You can buy long premium. All these things perform differently. As we said on the Option Block show yesterday, you could have options trades where both sides win or both sides lose, depending on how you hedge and everything else like that. So it's not a zero-sum game the way it is in futures, and it's different to kind of boil down, or difficult, I should say, to try to boil down the entirety of the universe of option strategies into some potential probability. I mean, I see people out there trying to say, oh, you sell out of the money puts or out of the money calls or out of the money strangles, you have an 85% win probability. Yeah, that's true up until a point. And then that point when you don't hit, when you blow through those strikes, is when you probably erase months, if not years, worth of profit off your rate. So in that case, what's the win rate then? Not that good. So it's a challenging thing, Nick, but an interesting thought process. Again, it kind of depends. And people might say, well, then you could flip the script and go long premium. That must be easier. And that's not exactly a win, a home run either. You have decay. Decay is working against you every day. So you have to do something like gamma scalping or something else to try to defend against that decay. And that already is outside of the wheelhouse of the lion's share, certainly of the retail traders out there. You need large accounts and specific margin and a lot of sophistication to be able to do that. So it doesn't make going long very easy either. So it's an interesting question. I haven't really thought about it in these stark of a terms, Nick, in terms of straight up percentages. Maybe you have. What do you have to say here for our friend, Mr. or perhaps Mrs. Vegs wants to know? He thinks futures win about 2/3 of the time. How do options fit into that scenario?
Well, it's kind of, if they won 2/3 of the time, then everybody would be trading futures, right? And then it's a
pretty good percentage.
Make money all the time, right? So I don't know where that's coming from. Maybe if it's their win rate, then I'd say that then he's asking the wrong people, because he's got a pretty good win rate if that's the case. I don't know that you can actually put an absolute number on that type of thing. I mean, if you get to the other question, I think we can probably segue into that one and answer a little bit of what Vegs is or Vegs or VEGS is asking. But it's a little different, right? The futures are more of a black and white trade. They go up and they go down, right? Where options, you could be. I was talking to somebody the other day. I was at a meeting and we were swapping stories about options trade and market moving, and you could be exactly right on your call from a directional standpoint and get annihilated on an options trade because you maybe didn't pay attention to the volatility. And that's what he was talking about. He's like, he wasn't paying attention to the vol. He was buying something based on the strike and not so much on the level. And it went right through where he was, but he got crushed because the vol was so high, and he did a hedge that didn't match. He did another opposite. He covered that winner with another option that was also trading high. From it was long a call, then he got long a put, thinking that he was covering his directional movement, but he ended up getting buried because the volatility got sucked right out of it. So, if I had a guess that because it's more of a black and white directional thing with the futures trade, that probably has a better win rate than options, only because remember, there's only one factor affecting the futures win-loss, and that's the direction of the underlying. Whereas in the options, you have 5 variables going in, right? So you have your strike, you have your futures price, you have your timed expiration, you got your volatility, and you got your interest rate. Now, the interest rate's not going to affect you so much. The strike, you sort of know what's going on, but you have your vol, and you have your futures price. So, those are 2 things, and those are 2 sometimes very disparate inputs that are going to affect what's going on there. So if I had to guess, I would say futures probably have a higher rate, only because it's less that can affect you. But what do I know? That would be my conjecture, purely based on the fact that one thing affects the futures and 5 things can affect the option.
Yeah, there's so much nuance into that options consideration. I like that example you gave, because that is kind of the prototypical example, is it not? People buy an upside call and XYZ the underlying rallies, and they lose money, or they make less money than they thought they would, even though the underlying moved in their direction. And that is still one of the most frequent questions / complaints we receive here on the network and at the website on a regular basis, nearly a decade into it, because people don't understand the volatility skew and the other nuances that we're talking about here on the show. So you're right. There's so much that can go into it that it makes it challenging to just say, options are a 78.2% probability, because there's so many different strategies you can do. It's kind of hard to compare one versus the other. But if that is your win rate in futures, you're not doing bad. You can stick with that. And then if you want to start using options as a way to augment your futures, maybe short puts to get into long futures, or short calls to get out of a long future, or vice versa, puts to hedge, things like that. There are ways you can use options. Maybe that should be a good starting point for you, rather than trying to switch products willy-nilly. Figure out how you could combine the 2 for maximum utility, capital efficiency, and profit. And who knows, maybe that 63 climbs up to a 73, and then you're looking pretty good. All right, we got time for one more here. This one comes from Charlie Trader. I like that. He asks, the economic calendar has many clues as to what may happen. Being a futures trader, I know what to watch. Is there a difference for options traders? Do you have any hints for us out there? Yeah, this is interesting. It kind of gets back to what we were talking about this week. This week's a good example, actually, with WTI and OPEC. There was clear and demonstrable event risk there on that calendar. And certainly if you're a WTI futures trader, you're going to be watching that event, because that's going to drive a lot of the futures. It's a similar thing with the options, where you're going to be looking at these same events, but the risk, the way it's going to play out, is going to be different. Futures are going to have that vacillation right around the event itself, and about a froth and uncertainty. With the options, it's going to be a longer-term buildup. You're going to see, if it's a big event, then you're going to see, like we saw last week in WTI, we saw vol starting to creep into that product ahead of the big OPEC meeting. And then what happened later this week? Vol spiked, got around to the meeting, the event happened, and then it wasn't a huge surprise. It was somewhat expected, somewhat a surprise, but not earth-shattering. So vol came off. I've used the analogy before. It's kind of like a balloon. The vol is filling up this balloon, filling up this balloon, filling up this balloon. The event happens. The balloon usually pops, unless something really unexpected happens. So what happens then? All that vol comes rushing out. So that's the way these events typically play in the options market. And the impact is going to vary. If you're talking the Fed and its impact on a big index, it might be somewhat more muted than, let's say, an earnings announcement or in an equity or a crop report in a particular agricultural commodity. More direct events on a smaller underlying are going to impact it more, obviously, than a large macro event on a large macro index like the S&P or the Russell or something like that. But that said, it's the same event calendar. We all look at the same event calendar. There's no secret options calendar that we all look at. It's just the way that those events play out on those calendars and how they impact options is obviously a lot different. And that depends to you, obviously, what your risk tolerance is, how you like to trade, how you want to approach that. Do you want to approach it from the long premium side or from the short premium side? They both have their advantages, they both have their disadvantages, and how they play out around those events and that event type risk is an interesting thing, and that's where the rubber meets the road for a lot of traders. Some traders just wash their hands of it and say, I don't want to deal with it. It's too much turbulence. Others like that. So it kind of really depends which way you like to trade. Mr. Nick, any thoughts here for Charlie T? And he wants to know what we watch on the calendar from an options perspective.
Oh, I think you did a good job of kind of summing it up. It is the event risk, basically. And like we mentioned for the Vegs answer, into a number, you have a future, you sort of know if it's going to go up or go down, right? So that's your risk there. But like Mark said, prior to a number, especially if it's an important number or an anticipated number, you're going to have things you're going to have volatility affecting it primarily, right? So you're going to have time and volatility that are going to affect it, right? So you're going to have some value because you probably put that option trade on earlier in the week or earlier in the month, whatever, and then you're going to have volatility. There's going to be buildup where people are going to say, well, there's just like you saw with the Brexit with the puts and the pound, right? There was a big volatility buildup. That's why we saw that big divergence in skew with the put and the call. And then after everything sort of happened and things, were absorbed or digested or whatever word you want to use, it came back out. So people could very well have been right for a lot of the directional point, but depending on where you entered from a volatility standpoint, when you got out, those kind of things, right? So you have to keep in mind, is it what else do you have to watch? You have to watch not just the underlying, but you have to watch the volatility, and you have to watch the time. And you'll see a lot of brokers and traders, they'll actually specifically calculate event vol risk. So they'll look and see how much, given if volatility usually trades around 20 for this 30-day contract, and volatility is now trading around 34 or 35. So that means that high volatility for that one day is going to have a very significant volatility level for, if you average, if it's a 30-day option and you have one day in there that's very high, you need one day in there very high to average out against the other 29 days that are very low. So you're going to really you can really hear the sucking sound or see the decrease in the level of the volatility after that one day is taken out, right? Because it's just how those calculations work. And if you want to, there's an event vol tool within QuickStrike. If anybody's interested, you could shoot me a note and I could show you how to use that. But you definitely have to watch for more than just the underlying. You have to watch, again, your strike price, where the futures are, how much time you got left, and where the volatilities level are, and where you think you're going to get in, right? If you're early, it's great. If you're late, it's not so great. If you're in the middle, it can turn out one way or another. But and you could be, like we've said all along, you could be exactly right and be completely wrong, just because of all those choices. So, it's not an easy game, obviously. Otherwise, you hear a lot more stories of the big winners. But those are the things to consider. And two great questions today, Mark. I think especially given that one was futures oriented and the other one was options oriented. I think they fit very well today.
I agree, sir. Unfortunately, that music means we've come to the end of the futures options feedback segment. It also means it's come to the end of another exciting edition of TWIFO. Quite the journey we went on yet again today, starting off in the realm of all things OPEC and WTI. What's up with the calls? They had some love. They kind of lost some of their luster, and then Nick just throwing a big wet blanket on all of it, saying poo-poo to that. So if you're a WTI bull, take it up with Nick, not with me. Also, the gold bugs, I should say, not really feeling the love this week either. It was pretty much all puts all the time. We'll see how that looks, but the nice thing about it, low vol out there means if you want to think about some hedging or some long premium type strategies, not exactly an expensive time to pursue something like that. Also some crazy trades out there, including 1900s lighting it up out there in Dees, which is optimistic, shall we say, even by gold bug standards. And we had some good questions talking and comparing and contrasting options and futures in some interesting ways. We'd love to hear from you guys. Keep hitting us up. And before we go, Mr. Nick, you guys are always working on cool stuff over there, out there in QuickStrike. In fact, you just mentioned something I didn't even know you had. You have event risk tools. I didn't know you even offered that. So maybe you should break those down. I'm sure our listeners who just ask those questions would be interested in that. And I'm kind of curious myself, as well as whatever else you're working on over there in the land of all things QuickStrike.
Well, as you know, I don't like to really mention stuff that's in the paid version because I don't want to seem like I'm trying to push the product. But that is something that's in particular in the subscription. So if you have any questions about that, just shoot us a note over at support@quickstrike.net or support@bantix.com, and I'll gladly give you some information, or you could sign up for a trial. So, and then we can talk from there. But as far as what else is going on, if anybody's out there using the CME Direct platform, as you may well already know. That's the trading platform that the CME has, and it's available at no cost from them. But we're also integrated into that CME Direct platform, so there'll be some new stuff that's integrated this week that you can take a look and see that right from that executable. And as far as stuff that's going on with us, another new build this weekend, so there's be some new functionality out there, especially in our vol skew and vol curve tools. You're going to see some cool ways to look at skew. A lot of times you can look at the same curve a week apart with no futures moving and the vol has shifted, but you can't really tell what that skew looks like. So we put some charts in there for you to be able to look at that very easily. So take a look and see what you think of those. And then the bigger announcement will be we're going to release a very comprehensive cross-product correlation tool via the CME Group website at some point in the next month, which is going to be pretty cool. You'll be able to see all kinds of different implied volatility correlations, underlying volatility correlations, that type of thing with scatter plots, and it's been a popular tool for the limited release that we have had. So keep an eye out for that. And then, of course, if you didn't look last week, you can look this week. The QuickStrike page on the CME Group website is a redesign, and it's got all 12 of the tools that are out there and easy to follow, easy to use. In particular, the heat map that's available out there as well as the Commitment of Traders report from the CFTC. So, and then if you are not busy next week, I'll be doing a couple webinars on tradingfloor.com for Saxo Bank. So take a look at those. I think those are occurring on Wednesday and Thursday morning this week. So look forward to talking to everybody next week.
Don't get enough talking on this show, huh? You're going to go do some webinars.
Going to do some more, do a little bit more.
You're getting the bug for it. I like it. All right, listeners, surf on over to QuickStrike. Actually, before you even do that, kick the tires over there at cmegroup.com/TWIO. This week in options, you can get all these cool reports. Nick and I are always talking about the skew and all the other cool stuff, all for free. So check it out there. Then if you like more advanced stuff, you can always head on over to what Nick's talking about with the event tool risk, more of the cool quick skew and everything else. A lot of cool bells and whistles under the hood over there in the land of all things QuickStrike. And on behalf of Nick and indeed myself, I want to thank all of you guys out there in the listening audience for downloading, streaming, subscribing to the show, and of course, for sending in such great questions. We love to hear from you guys. And we'll see you next time right here on This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.